So welcome today to our webinar, which is all about planning for the upcoming financial year end, which is the case for most of the audience having a 31st of March or 30th of April year end, but also importantly for the tax year end, 5th of April, which applies to all of us. And we thought it was timely to do something right now just to give you a few tips from both aspects, from the business aspect and also the personal tax aspect. For those who don't know me, my name's Claire Watkins. I'm a partner in Buzzacott and I head up the professional practices team. And I should just mention that this is aimed at professional practices. We're delighted to see that we have a number of people who are coming from different businesses as well, and you're very welcome to attend, but just be mindful that, and a lot of it will apply to any business, particularly the things to do with personal tax, but just be mindful that we're going to be using a little bit of jargon that probably only applies to professional practices. And by that, I mean law firms, architects, surveyors. So we're going to use a few bits of terminology like WIP for work in progress, and things that only really apply to those businesses. But everyone is welcome to stay on and hopefully get something out of today's session. A few housekeeping things. We're going to be recording this. You're welcome to submit questions using the Q&A function, and we've had a few beforehand as well, which we'll try and weave into what we're talking about. And we'll be running for a maximum of 60 minutes, somewhere between 45 and 60 minutes. Now, behind the scenes, we have two colleagues of ours from our marketing team, Chloe and Leanne. They're managing the production side of things and just getting everything to work as smoothly as possible. One thing to be aware of with these Teams webinars is that Teams has a little bit of a delay from when the camera switches from person to person. So you might hear a voice without seeing the face of the person talking for a few seconds after that. I'm afraid there's nothing we can do, but we'll try and do it as speedily as possible. Now let me introduce our panel. My lovely colleagues, we have Catherine Edwards. Now Catherine has been at Buzzacott for over 10 years. She looks after a number of audits and accounts preparation for businesses that are in professional practices and also a number of other types of businesses. And she's what we sort of refer to as a trusted independent advisor and helps out with cash flow planning, consultancy projects and things that apply to owner-managed businesses, but with a particular focus on professional practices. Then we have Jessica Beer. Jessica has been with Buzzacott for about 7 years and looks after the tax side of things, both for the business and for individuals in professional practices and in other businesses as well. And we have Simbre Barnes. Simbre has been a member of our financial planning team, which are basically independent financial advisors. She's been part of that team for over 5 years and she's a chartered financial planner. So she works with a lot of private clients from all sorts of businesses to help them understand their finances and develop strategies to help them meet their long and short term objectives. She's often called on to advise on pensions and investments and financial protection products and estate planning and that sort of thing. So we think we've got all bases covered when it comes to preparing for financial year ends and preparing for the tax year end. So first question is going to go to Jessica, and this will give our behind the scenes colleagues time to move the camera in a second, which is where the delay comes in. Jess, the 5th of April is just around the corner. Can you give us some ideas to help everyone prepare for the tax year end so that they can do things like maximising allowances and reliefs and reducing their tax burden?
Yeah, absolutely. I do think that the year end gives everybody a really good opportunity to take stock of where they are, where their finances are, and it is something that I would certainly recommend is done annually, and if not annually, at least every few years. You kind of hit the nail on the head when you said that making sure you utilise your allowances is probably one of the key things that I would say is good to do every year or in the year. That meaning if you have any personal investment income, making sure you're making the most of your dividend allowance for the year, as well as your savings allowance. If you're not many people know, but if your income is up to 100k or between 100k and say 130k, then you do reduce, that does reduce your personal allowance. It gets clawed back if you're around that income level. There's a lot that you can do to save your personal allowance then by way of charitable donations, because that gives you additional income tax relief, pension contributions as well. Pension contributions, as we're probably all aware, are probably the most tax efficient way of saving for yourself. I'm not going to go into the specifics now, because I think Simbre is going to talk about that a little bit later, but definitely making use of the allowances. Not many people tend to think about inheritance tax at anywhere early in their career, or even up to halfway through their life. However, there is an inheritance tax allowance which allows you to give up to £3,000 a year to someone for any reason, and that's just a good way of planning and helping to reduce your estate in the future. In terms of normal general planning for cash flow purposes, I would always recommend making sure that you're aware of what payments are due. So the next tax payment for most self-employed or people that prepare a tax return, it will be July 2022. So it's just making sure that you're aware of the amount that is due or is going to be due, so that you can plan for this. As we all know, sometimes planning is all well and good, but then things crop up in terms of your life. It might be school fees or medical bills, anything like that. So it's good to just make sure you have that set to one side and kept safe, separate from your normal day-to-day finances, if that's possible. If you're in business, so those that are in partnership here, if you know your profits are going to go down or are generally on the downward slope, you can do an exercise whereby it reduces the payments that are going to be due in January. If they're going to reduce, if the profits have reduced that much that you don't think you're going to be paying as much tax as you did perhaps for the previous year, it's definitely good. I'd say planning is definitely key, but to have a good overall understanding of your personal finances, where they're going in the future, any costs that are going to be coming up for you personally, that's the best way to plan. I'm not going to cover off too much more here in terms of personal side, but there is other things that you can do from a business perspective as well. I just wanted to quickly cover off that as well. So in terms of a business, it's really important to just make sure that you're aware of any changes in that are upcoming with the tax rates. So for example, corporation tax from the 1st of April 2023 is due to increase from 19% to 25% for what HMRC are now saying are large businesses, and that's anything, any business which have profits of 250k and above. That's a stark contrast to what large companies were considered as before, when the corporation tax rates were similar. But a lot of businesses we see now are going to be caught within that, and if they're not caught within the higher rate of 25%, then they're going to be caught within the main rate, which will be a hybrid rate between 19% and 25%, and that's if you earn profits of between 50k and 250k for the year. So it's just important to remember that if you're going to be planning, is to plan for the higher rates, to make sure that you've got enough saved. It is the person, whether you're an individual or if you're a self-employed business or a partnership, it is the responsibility of the partners or the individuals to make sure that they've got enough there for the tax. So even if the tax is reserved within the business, you want to make sure, or personally, that you're comfortable that there's going to be enough held there to pay the tax. Another one of the rates that is going up, I say is going up, it kind of already has gone up, but from April 2023, there's going to be the health and social levy, which increases the rate of national insurance payable by 1.25%. So I had a conversation with Kat actually yesterday, because the effective rate of the increase in national insurance is actually 10%. I don't want to boggle your mind too much, but essentially what that means is, before, if you were paying a national insurance charge of £100, now or going forward, you're going to be paying a national insurance charge of £110. So the effective increase between the 100 and the 110 is actually 10%. So just be aware of that for cash flow purposes, it will be a 10% increase in your spend, not the 1.25 as commonly advertised, or that is commonly now understood. So it's just about bearing all that in mind. There are also, if for personal tax reasons, there is currently a review going on of capital gains tax. Although that no changes have been announced to date, it's just important that we bear in mind that the rates could change in future. So if you're sitting on any large gains, I'm not saying, I'm not recommending that you have to sell any assets or realise the gains. But if you think the rates are going to go up, or you'd prefer to be prudent and pay the rates now, then realising some of those gains might be a good strategy for you going forward. It's really important with things like dividends and gains that you are in constant communication with your IFA, because that's where they'd be able to help you, and they're going to have a more holistic view of your finances as a whole. With businesses and capital expenditure, that's another big area that I think should be looked at more than annually, biannually, if you have the time. For normal businesses, there's been an extension to the annual allowance. Annual allowance is now at £1 million. That extension now runs to March 2023. If the allowance isn't extended any further, then just be aware that the annual investment allowance for businesses is due to reduce, will reduce back to the statutory, the legislative number of 250,000, which is a huge gap. As well, so it might be worth considering moving your capital expenditure forward or bringing it into an earlier financial year if that's possible, so that you can benefit from the higher rate of allowances. There's a similar allowance that is available for companies at the moment, which allows what's called the super deduction. It allows for 130% deduction of the full cost of some of the capital assets that are purchased. That also runs up to the 31st of March 2023. It may be that HMRC, it's all to promote capital expenditure post-COVID. So it may be that HMRC decide that these incentives are working really well, and that they'll extend them. However, we won't know that until closer to the time. For example, they didn't announce that they were going to extend the annual investment allowance until 2 months before it was due to expire last time. So that doesn't really allow enough time for planning. So it's just keeping that in mind. That was all I kind of wanted to cover off initially. I think
Thank you, Jess.
Pass back to Claire.
Yeah, thank you. That's great.
Yes, that's helpful.
No, that was, and I think the £1 million capital expenditure at the moment is fantastic, and we're seeing people wanting to advance the capital spend. They've got the IT spend, so if they're thinking about buying computers and renewing kit, and we've all been through a couple of years where we realised that we needed more computer technology than we did previously, then get that in while that £1 million allowance is still around, because it might not be around for too much longer. Right, let's pass over to Simbre in a second. Now, Simbre from our financial planning team. Basically the same question to you, but things to prepare for the tax year end. But can you also touch on pension planning, because we find a lot of our clients are quite underfunded pensions wise. They just don't have the disposable income really for it in a lot of cases, and also might not be aware of the restrictions that come into play when you start earning above 240,000 a year, and you find you actually can't pay much into a pension. So yes, I'll hand over to Simbre.
Thanks, Claire. Yes, so I think pensions is really a key one. As Jess mentioned, I mean, pensions remain the most sort of tax efficient way that people can save for their future, for retirement. So I guess the key thing with pensions is that at the moment, money that you put into a pension, you're going to get tax relief at your marginal rate. So for people who are paying tax at 45%, that's a really great saving. And obviously, as Jess mentioned earlier, particularly for individuals where you're in that band of between 100 and 125,000, you're going to be getting an effective tax relief of 60%, which is really great. And that's because you're reclaiming your personal allowance. So for most people, the way that the tax relief works is that they'll put in a contribution that's net of the 20%. The pension scheme will reclaim that 20% directly from HMRC, and then the additional sort of 25% will be reclaimed via the tax return if an individual submits a tax return. If not, you can call up HMRC and ask them to adjust your tax code. But the main thing is that you are getting tax relief at your marginal rate, which is really great. So other sort of tax benefits of pensions is that whilst the monies are invested in the pension, there's no income tax, there's no capital gains tax on any of the investment returns in there. So you're getting sort of a gross roll up of investments over a long period of time. Obviously, a pension is designed to save for retirement. So at the moment, you can't access that until you're 55. So it's just bearing that in mind. But, you know, for younger individuals, that means you've got a really long time period to sort of accumulate that wealth and let it sort of roll up. Now, obviously, when you take the money out of the pension, you are going, the income is taxed at your marginal rate. But you get, at the moment, it's 25% tax free. So because of that, you should be making a tax saving when you sort of take the inward tax relief and then the outward tax that you pay into account. A lot of the planning that we do with our clients is to do with drawdown and looking at the best way to take money in retirement. A lot of the time, what's really great is if individuals can get that tax relief on the way in at 40-45%, and then when they take the money out in retirement, we restrict that to just 20%. And then obviously with the 25% tax-free cash, that's obviously a really tax efficient way of doing things. So and also at the moment, it's also worth mentioning that the pensions are outside of the estate for inheritance tax. So another sort of benefit there. There are some rule changes which mean that whether you die pre or post 75, you'll either your beneficiaries will either be able to take the money out completely free of income tax, which is if you die pre 75, post 75, your beneficiaries will pay tax at their marginal rate. So, I mean, because of all these sort of great tax benefits that go with pensions, there's obviously limits on the amount that you can put into them every year, and this started out quite a high level, and it's gradually reduced over time. At the moment, the standard annual allowance is £40,000 a year for individuals, but as you mentioned, Claire, yes, there's been since 2016-17 changes which have basically restricted the amount that individuals can put into a pension where they are considered to be high earners. One good thing actually is that the sort of level of income at which you were before this tapering started happening has actually increased in the last couple of years. So the first year was actually last year, 2020-21, but it applies this year as well, and that limit is essentially 240,000. So once you've got income, and that's not just it's not just earnings, salary, bonus, that type of thing, it also includes all your investment income. If you had income such as rental income, whatever it is, that all is combined together, plus any employer pension contributions. Once that gets over £240,000, we see the annual allowance reduced by £1 for every £2 over. So once you get to 312,000, you're reduced to the minimum tapered annual allowance of £4,000 at the moment. So in terms of tax year planning, what I would say is really important to do right now for people is to think about their carry forward, because the good thing about pension contributions is that you can look back the last 3 years. So any unused annual allowance from the past 3 tax years can be used in the current tax year. The way it works is that the pension contributions in the annual allowance, for the current tax year is used first, and then you go back to the furthest one. So as we're coming up to 5th of April, I would say people need to make sure or check what they've got, if they've got any annual allowance from 2018-19, because that's the the tax year's annual allowance that's going to drop off when we get to 6th of April. So really making use of that would be great. And obviously in the past, we have heard governments talk about potential changes to pensions tax relief because it is so beneficial, and the increase in sort of revenue that the government would get from that. So, whilst there's no real, pressing talks on this at the moment, it's something that's always sort of floating around in the background. So I would say making those pension contributions, getting that tax relief while you can, if you've got the cash available, is really worth it.
Yeah, I agree. The camera's going to have a delay. Well, if you can push the camera back to me for a second, I'm going to go back to Simbre in a second with a question that we get quite often. But on the subject of pensions, it's use it or lose it, isn't it? I mean, whether you end up losing the generous pension allowance, tax allowance, because you end up earning over 240,000 and therefore you're restricted, or because at some point it might be taken away completely and it's just less generous, or it disappears. So while you are able to, or subject to having the cash available, of course, but while you are able to pay money into a pension, it is a very, very good thing to do. And it means, the money's going into your pension rather than into the taxman's coffers. Before we move on to, because I want Simbre just to talk a little bit about what people who are earning over 240,000 a year, but mainly over £312,000 a year, because that's where you're really restricted. Before Simbre talks about that, I just want to ask a question that we get quite often from clients, which is it better for me to pay into a pension or pay off my mortgage? And I know, Simbre, you won't be able to give a definitive answer to this because, of course, it depends on people's circumstances, but it would just be interesting to hear your view.
Yeah, thanks, Claire. Absolutely, it really does come down to the individual's circumstances, because everyone's situations are completely different. What I will say is that a lot of it comes down to your appetite for risk, and particularly what you're going to be doing with the money that you would otherwise have used to pay down your mortgage. The key thing here really is if you pay down your mortgage, that is a known certain outcome. You know that you are saving interest on that mortgage, and you know what amount that is. If, for example, you instead left the money in the bank, that's probably not going to be that great. That money's not going to work that hard for you. As we all know, interest on a lot of most cash accounts at the moment is pretty low, and inflation is pretty high, which means that money is just going to be eroded over time. If you were going to invest it and you're going to put it in your pension, then you're going to get the tax relief on that pension contribution, which is great, and presumably you're going to be investing it over a long time horizon. So it really depends on what the investment returns that you're going to get are, because essentially if the investment returns are greater than the interest rate that you're saving on the mortgage payments, then you're going to be better off. Now you're more likely to get a higher rate of return at taking a higher level of risk, and that's where it really does come down to individual situations and how they feel about risk and how they want to invest, and that's a separate story that would take a long time to go into, but essentially that's kind of the trade-off that we're looking at. All I would say is at the moment, obviously, we are in an environment where interest rates are increasing, and we know that the borrowing costs are going to be going up over time. So that does make it more attractive to be paying off your mortgage, because we know that those rates are going to be going up.
Well, maybe it's a case of having lots of eggs in lots of baskets, I suppose. And on that topic, do you want to move on to just talk about other things that people can think about doing, particularly if they're over the £312,000 earnings rate and therefore what they pay into a pension is so heavily restricted? There are lots of other baskets that they can put lots of other eggs in, aren't there? Do you want to cover a few of those?
Absolutely, and yes, spreading the risk and sort of taking this a bit of this, a bit of that approach. Often it can work well for people. So in terms of other tax efficient investments, particularly for those people who are subject to that £4,000 allowance, it's really not going to be you're not going to be able to do much with that. First port of call, I would say, is ISAs, individual savings accounts. I'm sure many people have heard of those. £20,000 at the moment is the amount you can put into an ISA. Any investment income capital gains are free of tax in the ISA, so it's great. Again, long-term savings vehicle. You can really, if you're using that allowance every year, you can build up a really tax efficient pot. And back to my earlier point about when it comes to drawdown in retirement and thinking about where you take your money from in the most tax efficient way, if you're restricted to, or you're trying to restrict yourself to only taking money from the pension that's within the basic rate tax band, where else do you take money that you might need to top that up from? If you've got a sizable ISA pot that you've built up over lots of years, that's really great because you can take the money out from there and it's tax free. At the moment, from an inheritance tax point of view, if you're leaving that to a spouse, there's what's called an additional permitted subscription, so you don't lose that valuable ISA wrapper that you've worked really hard over years and years and years to accumulate. So that's great. Other than sort of ISAs, I suppose there's other tax benefits for products such as EIS, which stands for Enterprise Investment Schemes, or VCTs, Venture Capital Trusts. These types of investments, you get 30% income tax relief on money invested in them, as long as you've got that tax that you had to pay in the first place. Oh, sorry, the light's gone out on me. So those types of investments are quite beneficial. From an income tax point of view, you also get, in the EIS, you can defer capital gains tax. You get tax-free dividends from a venture capital trust. They come with other sort of tax incentives as well. The only thing I would say about those types of investments is the reason they've got these great sort of tax incentives is because they are really high risk. They invest in either AIM quoted or unquoted companies, so they are risky investments, and we certainly wouldn't be suggesting anyone goes into those who has sort of a low appetite for risk, and certainly taking advice before going into those kinds of investments is key. And then lastly, I'd say, and this is something that's often forgotten, and Jess kind of touched on it earlier, is capital gains tax planning. And as Jess mentioned, there has been talks about capital gains tax rates increasing. And at the moment we're at sort of 10% for basic rate taxpayers, 18% if it's property, and then 20%, 28% for higher rate taxpayers. And also at the moment everyone's got an individual capital gains tax allowance. So current tax year, that's 12,300. So even if you weren't sort of realising gains in excess of that, it's really important, and it's really good sort of just housekeeping every tax year to realise if you've got taxable portfolios to sort of rebase them, as it were, and realise gains up to that 12,300, because you're not going to pay any tax on that. But all you're doing is meaning that in the future, you've got higher basis in that portfolio, and you don't need to pay tax on that at a later date.
Lovely, thank you, Simbre. That's really useful. I was thinking about a particular client of ours. I mean, we have several who want to use every kind of investment wrapper that there is, an investment idea that there is. But we have one in particular who quite regularly says, is there anything new that's come around that I can, invest in? Because he just believes in spreading the risk and trying to make the most use of whatever's out there. Which I think is very sensible. Now, we've talked at the moment about things to do with the upcoming end of tax year, and it's really from a personal point of view. I just want to move across to Catherine now to just talk a little bit about preparing for the financial year end. Now, I realise that some people on this in the audience won't have a 31st of March or 30th of April year end, and in fact, your year end may have already passed, but the majority of professional practices do have a March or April year end, and so that's why we're doing this topic right now. Catherine, with the year end approaching, what are the things that we should think about from a financial perspective?
Yeah, so first thing to think about really is sort of preparing your year-end accounting entries. So getting your accounts up to date on an accruals basis. So bringing in any expenditure that relates to the 2022 year end. The reason I mentioned that is obviously if you're accounting for things correctly, the tax treatment will follow. So if you're bringing in your expenditure, you'll get the tax relief on that now as well. So just to give an example of an accrual that we often see missed would be like a rent-free accrual. So particularly common at the moment, lots of landlords are offering really nice incentives to try and get people back into the city So if you have been offered, for example, a 6-month rent-free period, even though you're not paying any cash out at the moment on your lease, you still need to account for the expense evenly over the lease term. So the result of that is that you build up an accrual at the year end. Other examples would be things like bonus accrual that relates to the 2022 year end, even if you haven't received an invoice yet or paid the cash out yet. Other kind of year end accounting adjustments would be prepayments. So the opposite of an accrual, so spreading the expenditure if it relates to a future period. So really good examples for professional practices would be things like practicing certificates or PI insurance. Quite often you pay a year up front, so you need to make sure you take out the expenditure that doesn't relate to the year that's about to end. Things like depreciation and amortization, I would imagine most people are accounting for those monthly, but if not, then obviously putting in your year-end accounting adjustments to make sure any sort of non-cash accounting adjustments like that are all up to date. Other accounting adjustments to think about, things like provisions. So going back to the lease example, if you have a lease that has a dilapidations clause in it, most leases will say that you need to return your office space back into the original state it was in at the start of the lease. So if you do have a dilapidations clause, you need to build up a dilapidations provision. And again, the reason I mention this is that it's really important you account for it correctly to ensure you get the correct tax treatment. And I think Jess is just going to quickly explain the tax treatment on dilapidations.
So there's a term that's commonly used in the tax world as well as the accounting world, and that's capital versus revenue. So for dilapidations, sorry, I'm not even sure if people can hear me. It's my screen's telling me I'm on mute. Okay, good. So for dilapidations, it's quite to be allowable for tax purposes. Essentially, you look at the capital versus revenue nature of the transactions, and it's the revenue items that are allowable as a deduction against the P&L. For tax purposes, HMRC don't like to make these kind of things easy for us, so there sometimes are quite a lot of hoops to jump through. Just for a cost to be allowable, but there are lots of stated allowable and not allowable expenditure. When I say capital versus revenue, well, usually when I'm thinking about capital, it would be easier to think about something that has made a lasting improvement to the actual underlying value of the building or the asset, that then the business itself probably isn't going to carry forward. It's going to stay with the building if there are dilapidations on a lease, for example. In terms of revenue, it's just general wear and tear, painting. A lot of people would class as the replacement of worn carpets to be revenue expense. However, that's one of those tricky ones where HMRC say that if it's carpet tiles, essentially that can be tiles that can be picked up and taken away, then that can be an allowable revenue expense. However, if it's a whole fit out of a floor carpet or reception carpet space, then that would be considered capital. I do hope that that's somewhat helpful in explaining what's allowable and what's not. Obviously, if anybody has any specific queries of expenditure that they're not quite sure about, please do just get in touch. But for the meantime, I'll let Kat carry on with what she was talking about.
Thanks, Jess. Yeah, just really quickly to mention as well that there's slightly different accounting treatment for the capital versus the revenue. So if it's capital type dilapidations provisions you're building up, you'd capitalise that as a fixed asset and then depreciate over the lease term and release that expense to the P&L. Whereas the more revenue type provision, you build up gradually over time. So you expense a little bit each year and then you end up building up a provision on the balance sheet. So it's just slightly different accounting treatment. It's something that we really, really commonly see either not accounted for at all or accounted for incorrectly. So generally the best way to get an estimate is to actually employ a surveyor to do an estimate for you. But a lot of people don't do that. If the partners or directors can just sort of put together their best estimate of what they think they're likely to spend when the lease ends, yeah, it's just really important to make sure that you've got something on your balance sheet in terms of a provision for dilapidations. So thinking about other kind of year-end accounting type adjustments that might not always be obvious. So something like a provision for a legal claim. So if you've got any legal claims against the firm, if basically provisions should be accounted for if you've got a reliable estimate and if it's probable that you're going to have to pay. So generally with a legal claim, if you're covered by PI insurance, the reliable estimate is going to be the PII excess. So say that's 50k or whatever it might be. And then you've got to think about how likely do you think it is that you're going to have to pay out on that claim. If you think it's probable, so if you think you are going to have to pay out on that claim, then the provision should be accounted for immediately. That's generally the accounting treatment for provisions. As soon as you know that you're going to have to pay something out, it should be accounted for straight away, even if you're not going to have to pay out the cash for a while. The only other thing I wanted to mention about sort of year-end accounting things to think about is limited companies. Obviously you'll be putting together your corporation tax return, and something to think about around the year end is R&D. This is particularly important for the architects amongst the audience. Most of our architect clients have been making really successful R&D claims in recent years, and it's something that's still very much on the agenda of HMRC. So if you've not made a claim before, then definitely something to think about around the year end. Obviously only relevant to limited companies at the moment. Unfortunately, if you're an LLP, you can't make an R&D claim. But yeah, limited company architects that haven't yet made a claim, definitely something worth thinking about.
Lovely, thank you, Catherine. I was just going to move along the agenda a little because we're running slightly short on time. Can I just move to, hold on a second, I've lost my place. Yeah, Catherine, when we're looking at LLP accounts, sometimes there's and this won't be relevant to the limited companies who are in the audience, but just bear with us for a second. When we're looking at LLP accounts, we sometimes see a situation at the year end where certain partners are overdrawn. Can you just talk to us about what that means? Because it does come through in the financial statements, and I think it's of concern to people.
Yeah, sure. So for an LLP, obviously the assets of the business are broken down between the individual members, and that generally is made up of their capital account, current account, and tax reserve account. Some LLPs only distribute their profits after the year end. It all comes down to your LLP agreement and what the particular wording is in the LLP agreement in terms of when the profits are allocated. But for those that allocate them later, it might be that partners have actually drawn more profit. So their drawings from the business have been more than the profit they've been allocated. Therefore, at the year end, they're actually overdrawn, which technically means they owe the LLP money rather than the LLP owing them money back. So just something to keep an eye on. If that is the case in your year end accounts, that sometimes is a bit of a red flag to, say, banks or other users of the accounts. It's generally one of the red flags that we kind of spot in a set of accounts if a partner is overdrawn.
Right. Sorry, Kat, go on,
okay.
Carry on.
No, I was just going to say, just really quickly, just to mention about tax provisions, not all LLPs reserve for tax within the business. Some partners are paid gross, and then they reserve for their tax separately. But if you are reserving for tax within the business, just really important to ring fence that money and make sure it's not used as general cash flow to keep the business going. Just keep that tax money separate so that it's there and readily available come January and July to pay the partners' tax payments. Shall I just move on quickly? So I was just going to mention, obviously with year end approaching, one of the things that businesses are likely to be thinking about is what levels of bonuses, or for limited companies, dividends, what they're sort of thinking about paying. I just wanted to touch on, Jess has obviously already mentioned the increase in NI that's due to come in April. And something that a lot of businesses are thinking about is whether to front load bonus payments and pay them out in March. Which might be obviously before your year end, just to try and avoid that NI increase. Obviously, you need to be mindful of cash flow, and you're unlikely to know what your profits are going to be at this stage until they've been audited or whatever. But you might also want to think about the personal position of employees, because for some individuals it might actually have a negative tax impact by paying a bonus earlier in the year before the 5th of April year end. But just something to think about if you are sort of mindful of saving that extra NI. The timing of bonus payments could be switched up slightly this year. Something else businesses tend to think about, obviously, around year end is promotions. So for LLPs, for example, thinking about promoting some employees up into sort of partner status. Obviously, moving from an employee to a self-employed individual has a number of implications from both HR perspective, so sort of loss of employee rights, changes to pensions, but also obviously from a personal tax point of view, it'll be the first time that those individuals are treated as self-employed and have to pay tax in January and July rather than obviously through PAYE. Also, with promoting people up to partner, additional capital contributions that you might want to get from new members, but also from your current partners, and whether you've got the right level of capital to be funding your business. So moving on from accounting type entries, I was just going to talk quickly about maximising cash inflow around the year end. So trying to bill your WIP. The sooner WIP is billed, the quicker you've got the chance to actually recover that money and get cash through the door. Also making sure that any WIP provisions or bad debt provisions are up to date at the year end. So what you've got in your balance sheet at the year end, that should be the recoverable amount. So any WIP, that should be WIP that you really truly are going to convert into an invoice. Same with your debtors. Any debtors you've got on the balance sheet should be recoverable debtors. If you don't think you're going to recover that money from a client, then that debt should be written off. So it should be a nice clean balance sheet at the year end. It's a good time to have a debtors collection drive as well. Try and chase your clients, whether that's through sort of fee earners, chasing clients for a sort of more personable approach, or making really good use of your credit control teams for a more direct approach, but just try and get that cash through the door. The other reason for mentioning that as well is just to touch on the tax treatment quickly. So if we're talking about bad debt provisions, general provisions aren't allowable for tax purposes, but specific provisions are. So if you're putting in a provision against a specific invoice, i.e. sort of a specific client, then that is allowable for tax purposes. So just be a little bit careful with your bad debt provisions to make sure you're getting the right tax relief on that.
Great, thank you, Catherine. Just looking ahead to the new financial year and having started the conversation with various clients, we're seeing some of them taking a slightly different approach to the new year. Can you just run us through some of their plans?
Yeah, sure. So I think particularly sort of off the back of COVID and the uncertainty that came with that, people are a lot more conscious of budgeting, forecasting, cash flow planning, that type of thing. So obviously with the new year about to start, it's a really good time to be thinking about putting together a budget or a cash flow for the next financial year. Obviously, if you're large enough to be audited, that's something that you'll be doing anyway, as it's a requirement. But for the smaller firms, if you've not prepared a cash flow forecast before, it's definitely something to think about. So things to think about including in that. Inflows and outflows relating to partners joining or retiring. So if you're promoting people up to partner level, sort of as I just mentioned, thinking about what kind of level of capital you might want to ask for, what level of capital do you think you need to run the business. If you've got partners retiring, they're obviously going to want to be paid out their capital and also any undrawn profits. So quite often that's paid out over a few years. So planning for those future outflows of cash. Thinking about your staff and salaries, so factoring into any forecasts increase in staff numbers or planned pay rises, thinking about that extra 1.25% of national insurance contribution. So you want to factor in any large unavoidable outflows, so corporation tax, VAT, or for LLPs, the January and July tax payments. You're going to have those kind of crunch points throughout the year where you've got those big outflows, so it's just planning ahead to be able to manage that. Think about any project type expenditure. So Jess obviously mentioned this as well with the nice extra allowance that's in place at the moment. So if you've got any big IT expenditure, factoring that into your forecasts might be a good time to do it now rather than later because of those nice tax allowances at the moment. Think about your predicted revenue as well. So this is something that we actually see our architect clients do really, really well. Quite often they'll have almost like 3 forecasts, so a best case scenario, your sort of expected scenario, and then worst case scenario. Obviously a lot of, as accountants, we're quite lucky that a lot of our revenue is recurring year on year, but for the architects and the law firms, it tends to be more sort of one-off bigger projects. You don't always know what work's going to come in. So having those 3 different levels of sort of scenarios can be quite helpful when sort of forecasting. And also doing some stress testing on your forecast. So just to take an example, if work dried up by say 20%, how long are you able to run the business for? How long is your cash going to last before it runs out? So putting together some kind of stress testing and contingency plans can be really useful. The only other point I was going to make was just sort of putting a business plan in place for the new year. Try to be more forward thinking rather than thinking, how are we going to cut costs? Sort of taking the approach of how can we get new business in and planning ahead for that. It might be a nice time as well to do a bit of sort of benchmarking. Once you've got your results, do a bit of benchmarking against other similar firms and look at your KPIs, key performance indicators. So looking at some ratios like how does your gross profit margin compare to other firms of a similar size, just to see how you're doing. It's quite a nice time of year once you've got your results to have a look at things like that. That was all I was really going to say on that.
Lovely, thank you, Catherine. I think I'm just going to jump ahead because I just want to bring Jessica back in. There is one thing that we've mentioned before, but it is so important that I think it's worth Jessica just covering it quickly again, which is the basis period reform. Again, this only applies to LLPs and partnerships. So for the limited companies out there, forgive us if we just quickly divert onto this, but it does mean a potential change to the year end. Jess, we're running a bit short on time, but do you think you could just cover it as briefly as you can, just to make everyone aware of when this is actually coming in? Jess, so we can't, I think you're off mute. Can you hear us?
Sorry, I can hear you, but I can't see anything.
Okay, do you
having a bit of IT trouble?
I think we can see you. So do you want to crack on? If we stop hearing you, I'll take over.
Okay, bear in mind I can't see any of my notes at the moment. My screen is just completely black.
Do you want me to take over, Jess? I can do.
No. Honestly, it's fine. So the basis period reform is something that's been introduced by HMRC to align the taxable profits to the UK tax year. So essentially what they're trying to do is that eventually the 12-month period that's taxable will run up to either the 31st of March or the 5th of April. Now, for most businesses, that will be unincorporated businesses and partnerships, they won't have or they may not have a tax year that runs in line with the UK tax year. So what that would mean is essentially that if where the year end doesn't align, 2 sets of reporting or 2 sets of information will need to be prepared and then added together for the purpose of reporting it on either the LLP or the individual's tax returns. So HMRC initially released a consultation document about it a couple of years ago now. But the decision has been made and it's now, I think, due to be legislated to have this fully implemented by the 2024/25 tax year. So what that means for individual businesses is that they're going to allow a transition year to make sure that everybody knows what they're doing and gets it correct in the 2023/24 tax year. So if we take a business, for example, that has a year end of the 30th of April, that would mean that would include their year's profits to the 30th of April 2024. because that's what's taxed, that it would usually be that 12 months that's taxable in the 2025 tax year. So if we bear in mind that we're already coming to the end of the 2022 year, if you've got a 30th of April year end, what that essentially means is you're only going to have 12 more months that are going to be taxed in the normal way as you have been in the previous, say, even 10 plus years, that are going to be taxed in the normal way that you're used to. So it's really, really important that from, say, the 1st of May 2022, you start to think about things such as perhaps even changing your year end so that it aligns with the tax year. And if you're going to do that, in what period do you want to change the year end? Changing the year end has a number of other beneficial factors in that it will crystallise any overlap relief that's been that a partner has from the initial years of when they became a partner. So that's quite good. What it also will do, though, is it will bring forward some of the tax that you have payable. So HMRC recognise that you're going to be paying tax earlier than you perhaps would have been. So they're allowing businesses to spread that tax over a 5-year period, which sounds really good. However, that's in many cases that just wouldn't work for a business when you think, or especially an LLP or a partnership within a partnership structure, you might have partners that are going to retire within the next 5 years. So it's just thinking about who's going to make the payment, how are you going to make the payment, are you going to need to get external financing? Simbre mentioned earlier the ever increasing interest rates that are going to be payable, which means that the cost of borrowing is just going to increase as we move on in the current state anyway. In conjunction with that, I just briefly wanted to mention that Making Tax Digital is also going to be implemented for individuals by, it's been postponed, but HMRC are hoping by the 5th of April 2024. So in terms of increased cost for tax, you're then also going to have an increase in cost for compliance, because the way Making Tax Digital works means that you could be required to make up to 6 submissions to HMRC in any one tax year, as opposed to the one, perhaps 2, one for VAT, one for income tax, that you're used to making to HMRC currently. So it's making sure that you have all the correct systems in place, the correct software that's going to be able to capture that real-time data for the quarterly submissions that will be required to HMRC. So there's lots of changes in the air that
there really
are due to make, or it's been advertised to make, the whole tax system a lot easier. And who knows, 10 years down the line it might do, but from the outset, the big P word, planning. Please make sure that you have all of this in mind, even if it's just to add it as an agenda point to your next board meeting or partner meeting. It's worth talking about now.
Yes, thank you. We are almost at time. I think we're probably going to end up doing a separate session at some point on the basis period change and Making Tax Digital, because there are so many questions coming through for it. Just for the benefit of the LLPs and partnerships out there, the year that you really need to start thinking about this and act is 30th of April. If you have a 30th of April year end, then 30th of April 24 is probably going to be 31st of March 24. You're probably going to want to move that year end in the 24 year. You can do it sooner, and you don't have to do it at all, actually. But if you don't do it at all, then you're going to have to come up with a completely separate set of records for tax purposes. So in practice, and Buzzacott's going to do the same because we have a 30th of September year end, we're all going to change our year end to 31st of March. That seems to be the way it's going to go. Thank you to the panel for all your insightful topics and information. Thank you to the audience. Do continue to give us suggestions of other things that you want us to cover. We're hoping to do an in-person seminar as opposed to webinar. Then we don't have to keep taking ourselves off mute the whole time and trying to make sure the IT works. So we'll keep you informed on that. Thank you also to Chloe and Leanne in the background for managing the production side of things, and we'll see you at the next one. Bye-bye.